The surprising rise of long bond yields amidst Fed easing. The Federal Reserve initiated its easing cycle in mid-September of this year, implementing an aggregate rate cut of 100 basis points to date. Surprisingly, the 10-year Treasury yield has not mirrored the Fed's action by declining. Instead, it has climbed nearly 75 basis points since the first cut, representing the largest increase across the last 13 easing cycles since 1982. What might this unprecedented movement indicate? The U.S. economy has performed more robustly than anticipated since the Fed began the current easing cycle in September. Inflation, rather than continuing its downward trend, appears to be stabilizing. These macroeconomic developments have driven the long bond yield higher, reflecting a divergence in sentiment between bond investors and the Federal Reserve. Investors seem skeptical of the Fed's decision to lower rates, viewing the economic data as inconsistent with aggressive monetary easing. Supporting this view, Federal Reserve Chair Jerome Powell adopted a hawkish tone following the FOMC meeting last Thursday, signaling that the pace of rate cuts will likely be less aggressive than initially anticipated. Additionally, some analysts attribute the rising long bond yield to worsening fiscal conditions. The fiscal deficit reached a record $624 billion in the first 2 months of the 2024-25 fiscal year, while outstanding public debt has soared past $36 trillion. Alarmingly, interest expense already consumes 15% of tax revenue and is projected to surpass 25% within the next decade. These factors have raised investor concerns about U.S. Treasury securities, dampening demand and driving yields higher despite the Fed's easing stance. Looking ahead, the U.S. Treasury market faces substantial challenges. The combination of resilient economic performance, deteriorating fiscal health, and an impending maturity wall of over $7 trillion in public debt in 2025 suggests persistent upward pressure on yields. Compounding these issues, the potential for renewed inflationary pressure stemming from Trump-era tariffs could limit the Fed's ability to continue cutting rates, potentially even halting the easing cycle. As a result, the 10-year Treasury yield could continue to rise, potentially surpassing the 5% threshold in 2025.